Well, for something to naturally emerge as money, it needs to serve different purposes. There's 3 different purposes for something to serve as money. The first one is medium of exchange. Medium of exchange is a difficult word for something to serve as a payment. So medium of exchange is when a good serves as an intermediary in between the exchange of goods and services. If we don't have a medium of exchange, we are back to, what are we back to? Barter. Barter trade. Good, Luke. You saw my speech already, so you're cheating. We're back to barter trade. I own a cow. Luke owns 100 chickens. I want to buy 2 chickens from Luke, but I only have 1 cow. Very impractical. Goodbye for me. But if we have money and then I can slaughter my cow, I get 100 units, so then I use a couple of units to buy the chickens. So the second one is unit of account. Unit of account is a frame of reference. So if I tell you something costs $100, you all have a mind reference to how much is $100. You know how much $100 is in terms of purchasing power. You all have an idea of how much it is. So it's a standard measurement, a frame of reference. Store of value. Money is supposed to keep its purchasing power over time. How well has this been keeping its purchasing power for 100 years? Badly. Very bad indeed, La. It lost about 99% of its value in the last 100 years. So what cost $1 100 years ago cost $100 today. And this is actually a better track record than most currencies. Most currencies are no longer here. That was, that came up during the last 100 years. But the currencies that's been around for 100 years, like the US dollars, the pound sterling, have lost 99% of their purchasing power. So store of value, today's currency system haven't been having a very good track record, to say the least. Now, characteristics. There needs to be certain characteristics of money to fulfill these purposes of money. And to check the characteristics, we can compare again this $100 bill with gold. Whoops, there's gold everywhere. With gold, this is a 1 gram gold bar. I will come back to that. Now, durability means that money is not supposed to burn, it's not supposed to oxidize, and it's not supposed to be able to be easily deleted. Now, this one burns very well. The 1 gram gold bar, or any gold bar, well, it can melt, of course, but it just takes a different shape, takes a different form. You can't actually get rid of it. It will just go back to a different form. The second one, possibility to move. It's easy to move both the $100 bill and the 1 gram gold bar. And of course, it's easy to move. Most of our money today just exists in an electronic form. Actually, in Singapore, we have 93% of our monetary supply existing as electronic digits only. So very easy to move, but also very easy to delete. Who's sitting on the delete button? You know, you can delete it by a stroke of a key on the keyboard. Divisibility. Divisibility is the most interesting one. So let us do an experiment to show the divisibility of money, because this tells you a whole lot about the current monetary system. Now, let's get back to the 1 gram gold bar, a very small gold bar. Let's pick it up. What happens if I split this gold bar into 2 pieces? What do I get?
2 gold bars. 12 bars and half a gram.
That's correct. 2 gold bars, about 0.5 grams each, right? So I will now do this. I'm splitting this one. Am I destroying the value of this gold bar? Appreciate it. It's not, it's like 0.55 and 45. But it's about 0.5 grams each, right? Together, it's still 1 gram, correct? So I still have 1 gram of gold. Now, what happens if I split this one into 2 about equally sized pieces? Should we try? What did I get? What is this?
Paper.
Yes. Is it $50? 50, 50?
I believe it or not, but you can actually swap it at any bank if you have more than 50% of the money.
That's right. So I have 2 worthless pieces of paper, right? So this is the intrinsic value of today's money. It's worthless. I can use this maybe to scribble a bit on, or I can use it as emergency toilet paper, but that's about it. You know, it's not worth anything. It's intrinsically worthless. So that tells you a whole lot about today's monetary system. Fungibility. Fungibility means that every piece is supposed to be indistinguishable from each other. So if I lend you a 1 gram gold bar, you don't have to pay me back that exact gold bar. You can pay me back any 1 gram gold bar. You know, but for this $100 bill, which used to be perhaps a $100 bill, you have the same size for a $10 bill, but they are supposed to be differently valued, although it's the same size. So they're not really fungible. Intrinsic value, of course, comes back to the metallic characteristic. You know, I told you gold is just the best metal out there. So you can see clearly that gold has much better metallic characteristics than fiat paper money, because gold is money according to the definition of money, whereas paper fiat money or its electronic counterpart is actually not money according to the monetary definition. Now, let's fast forward to today. So that's a brief history of the history of money. But question is, has gold lost its shining appeal, its 6,000-year appeal? If you look to mainstream media, there's been a lot of gold bashing the last couple of months and the last couple of years, perhaps. Isn't it interesting that this has lost 99% of its value in 100 years, but there's no fiat paper money bashing in mainstream media? There's no articles criticizing our monetary system, is there? There's a lot of articles criticizing gold. Gold has lost its appeal, of course, losing a couple of percent in a couple of years, even though it's maintained its purchasing power for some 6,000 years. Whereas fiat money never survives, but you never read about that, do you? So the reality is that the demand for gold is sky high. The Western vaults are vacuumed for gold. The stockpiles are getting really low currently. This part of the world, China, India, Southeast Asia, are vacuuming the Western vaults for gold. The demand in China especially is insatiable. And listen carefully now, because this is probably the first time you will hear this. I will tell you that it is actually good and healthy that the price of gold is going down. Why is that? Why? Because the price of gold is set on the paper market. And paper gold is part of the IMF fiat mess. So it will burn itself out. And as it burns itself out, it's expected that it goes down. It's expected that it goes towards zero, because there's so much paper gold. Anyone's guess how much it is, but at least a ratio of 100 to 1 in terms of paper gold to physical gold. So it's not strange that paper gold is going down. But we get shortages for physical gold, and that's what we see now. We have quite big shortages for physical gold, even more so for silver now. The premiums are skyrocketing, and it's difficult to find any physical silver whatsoever. So it's not strange that the price of gold goes down. It's a good thing, because that is getting us closer to the revaluation of physical precious metals, and I will come back to that shortly. Now, to understand gold, we have to understand the global economy. And how is the health of the global economy? Well, stocks and bonds in the US have been performing decently over the last couple of years, but the rest of the world not doing so well. I mean, a lot of developing economies, the stock markets are crashing, their currencies are crashing, and they're not doing very well. And of course, the US, I mean, they are surviving on easy credit, record low interest rates, or even negative interest rates in some countries. Sweden, where I originate from, they have a negative interest rate now. So you actually get paid to borrow. How good? And vice versa. And you have unprecedented QE, but it's not triggering any real growth. And the underlying economies are performing very badly. You know, you have a lot of unemployment, and the real developing, producing companies are not doing so well. And it seems that it's even at the point now where the viability of innovating, producing, developing new products, doing real things, real stuff, has become secondary to corporate managers putting their companies on the stock exchange. So it's more important for company managers, company owners, to put their companies on the stock exchange than it is for the company to actually produce and do something real, to do something good. And this is definitely a sign of where we are in those times. So we have a system of debt bubbles, of malinvestment, easy credit. Now, how did we get here? In this context, the US dollar as a reserve currency is very important. Because the US has, of course, been running perpetual trade deficits for some 4 or 5 decades now. Running a trade deficit is basically the same as there's more stuff coming in than there's stuff coming out, very easily. Much more coming in than going out. How do they finance it? Well, print money. Easy. How are they able to finance it by just printing money? Well, it has been the case that the rest of the world, and the rest of the world in this context is the non-US countries. So the non-US countries have been saving the US dollar for savings purposes. So as a reserve currency, there has been a demand for the US dollar to be saved as a reserve currency. And in this industry and in alternative economics, there's a lot of finger pointing towards the US, saying that, okay, the US lives beyond its means. And they are. But in my opinion, it's not actually the fault of the US what's happening. Because if the rest of the world, the surplus countries, wouldn't be saving the US dollar as a reserve currency, then this wouldn't have been possible. Because if a normal country, non-reserve currency country, would try to maintain a perpetual trade deficit, it wouldn't be possible. The currency would lose value. The currency would depreciate to balance the trade deficit, meaning that imports would get more expensive and exports would be cheaper for others to buy. But this is not happening in the US. And then the question is, why is this not happening? Well, again, it is that the surplus countries are saving the US dollar excesses as a reserve currency. Now, is this sustainable? Is this like the holy grail for the US? We have a reserve currency, so we can live beyond our means forever? No, it's not, because you can't borrow forever with no intention to pay back. It's not going to work for them. Even in what happened in 1971?
The oil crisis.
Sorry?
The oil crisis?
Yes, well, yes. So President Nixon closed the gold window, right? And even so, the other countries didn't like that too much, but they accepted it on the premise of easy credit and cheap oil. But they weren't too happy about it. But structural changes are overdue. And what we see now is that countries are no longer very interested, surplus countries are no longer very interested in accumulating US debt, US bonds, US treasuries. So they are no longer increasing their holdings. And what we have seen a couple of months ago, of course, the Greece debt crisis. This is an interesting foretaste to what we can look forward to. Because Greece is, of course, a very small economy in the global context. But the situation is the same or much worse in many other countries, larger economies. Italy, Spain, Portugal, Japan, and the US. And, during the last 10 years, we've had these cascading bailouts throughout the system. Now, who's going to bail out the US? Who's going to bail out the IMF? Who's going to bail out the ECB? There's no one going to be, no one left to bail anyone out. So the Chinese, of course, they understand all of this. And you can see here for the last 4 years or so, even though they're running a very big trade surplus, they are no longer very interested in increasing their US debt holdings. So the US bond holdings have been plateauing off in the last years. And the last month has even, I don't know if you are following this better than me, but there's been rumors of them selling some of the holdings even, zero hedge rumors. So they understand that they have to differentiate. Who's been picking up the slack when the Chinese are no longer interested in US debt? Well, this is a chart of the central bank in the US, Federal Reserve, and their holdings of the US bonds. So the US holdings, the government, it can be debated whether Federal Reserve is government or not. It's pretty private. But this is a chart of Federal Reserve's holdings of US debt. So we can see 2009 something happened, shoof, up here, and this is the increase of their holdings in US debt. So this is the same as QE, of course, quantitative easing. What's happening is that the US is importing more than it's exporting. They're running a trade deficit. They are financing that trade deficit by issuing bonds. No one wants to buy the bonds, so the central bank itself has to buy the bonds. Same thing as printing money, because it's just a bookkeeping entry. They create money out of thin air by a bookkeeping entry, creating money just like that. Now, this has plateaued off here since 2014. So they are now supposedly tapering. They are no longer doing the QE. Okay, so what happened here? Well, there's a lot of developing markets crashing. A lot of developing currencies crashing. And that's what's been happening for the last year. So the only reason that they have actually been able to do this is that non-US investors are actually conditioned to run towards the US dollar denominated assets when their domestic markets are crashing. So there has been a lot of demand for private individuals in developing markets to buy US bonds during the last year. Now back to the tapering here. So are they going to continue to not do the QE? Well, what's going to happen now? We talked about there's no longer any public foreign support for the US debt, meaning that the surplus countries, China and so on, they are not interested in buying no more US debt. They want to decrease if they can, but they can't really, but they want to. And private individuals in non-US countries, they've been upholding it. But what about when that is waning, the private non-US support? Who's gonna pick up the slack then? Well, nobody. So then they will have to restart the QE. So I believe all this talk about tapering is very silly indeed, because they have no option. If no one else is buying, they have to buy themselves. Otherwise, the debt auctions are going to fail. And what happens if they fail? Well, the interest rate is going to skyrocket, and we're done overnight. So the situation currently is very, very fragile indeed. So we have a perfect storm brewing here, in my opinion. Public support is gone, private support might stop anytime. And it is when people, who thinks that the US government is solvent? Who thinks that they're going to be able to pay back their debt? Not so likely, right? The US government, of course, the national debt is 17 trillion US dollars. And unfunded liabilities are anyone's guess, but 100 to 200 trillion dollars. No one believes they're going to pay back this. But the inflection point here is when people start to act on this knowledge that they have already. Because when people are starting to sell their US debt holdings, their bonds, their treasuries, that's when we're going to have an avalanche of deleveraging happening. And that's going to be a very, very tight exit with people trying to squeeze through and no one buying. Now, in precious metals and Austrian economics, there's a lot of people arguing, are we going to get a deflationary depression, or are we going to get a hyperinflation? Which one is it going to be? And people, as I said, I'm Swedish by origin, and I got an article posted in Swedish on the Meisterste Institute in Sweden. And this was just about this, like deflation or hyperinflation. And there were 500 comments, and like 4 guys commenting 40 or 50 times. And at the end, they all hated each other. So they're sharing like 99.9% of everything, and then it's like small differences, and then they hate each other. So this is, common argument in this sector. Now, what a lot of people don't realize is that the deflationary depression and then hyperinflation is basically the same thing. But a deflationary depression precedes a hyperinflation. So we can see already now that we have quite strong pressure for deflation. Debt is defaulting. We are at debt saturation, so perhaps not as much in Singapore, but globally, especially in the West. People can't take on any more debt because they are busy servicing their existing debt already. So a hyperinflation happens when, in a deflation, the government buys up debt at all costs to kick the can forward, as always is the case. Because government is always monetizing debt. They want to be re-elected. That's the main objective. And to get re-elected, they have to kick the can forward because deflation doesn't look good. Whereas inflation, we might have a chance to get re-elected one more time. So that's usually what's happening. So hyperinflation always starts with deflation. That's important to remember. So the signs we have to look for is when we have a confidence loss in the economy, because that's when we get close to a hyperinflation. When we have a confidence loss in the economy, the savers are starting to spend. So the surplus countries and people, saving in terms of fiat currency. They are starting to spend all of a sudden, so that what's called the monetary velocity is increasing, meaning that the money is turned around quicker in society. You spend to get something real, to get something tangible, like gold and silver, instead of keeping savings in fiat currency. So signs you really should look for: confidence loss, monetary velocity, savers starting to spend. Now back to the Chinese. The Chinese understand all of this, so they buy a whole lot of gold. In 2014 it was about 2,000 tons. This year it might very well be 2,200 tons. Remember, global mining supply each year is about 2,700 tons. So this is already close to the global supply of gold for each year. And adding to that, the Indians are buying 1,000 tons and the rest of the world. And then you can see that we're taking a lot of the stockpiles, and there's not enough gold around to keep this up. Why is this? Well, the Chinese understand that gold is a stable savings asset. They understand that the days for the US dollars as a reserve currency are counted. And they understand that gold is savings. Gold is not an investment. Gold is savings. They understand this because it's safe. It's a safeguarding, I should say, against inflation and currency destruction. And if you have gold, it gives you independence. This is something important for the Chinese. For the Chinese, it's very important to have a strong core. They don't want to be dependent on no one. They want to build a strong core. How can they do that? Get a lot of gold. Because the gold backstops their currency, the renminbi. So it helps them to internationalize their currency. And gold is power. They understand that gold is power. It has been for 6,000 years. It's not likely to change anytime soon. So the Chinese, up until 2003, it was illegal for private individuals to hold gold in China. So you can see the development here. It's quite extraordinary. 2003 it was illegal to hold gold. And the gold holdings, the total gold holdings in China, about 4,000 tons. Today, the best estimate is about 14,000 tons. So very explosive development indeed. The official reserves was just updated after a 6-year hiatus. So they increased from 1,054 tons to 1,658 tons. And the rest are private holdings, of course, like it should be, because the gold should be in the hands of private people. That's where it belongs, and the Chinese actually understand this. But you have this immense geopolitical trend here, of course, because where is all this gold coming from? The West. So it's coming from the Western vaults, and it's going to the East. It's coming from the London vaults, from the New York vaults, and it's going to especially China, but also Southeast Asia and India. So the Chinese are determined to be the next trade center for gold. And they're setting up the Shanghai Gold Exchange. Very importantly, they're setting up the Shanghai Gold Exchange to be the next major trade center for gold. What's differing the Shanghai Gold Exchange from other gold exchanges? What's the difference? It's physical. It's all physical. Well, it's not all physical. We also have paper trading, but it is physical.
And cash, right? You gotta pay cash. I can't get it.
Well, I don't know. Perhaps. Well, but the thing is, it's physical. So they understand that when the paper mass is burning itself out, you need a physical. I'm losing my cue because I'm getting too excited. Yeah, no, so they really understand that the market is going to be physical indeed. And it's very important for them to set up a physical market based on physical demand and supply, back to the basics. Because when the paper gold is going worthless, they gonna have the pricing power. They gonna have a price discovery at the Shanghai Gold Exchange. And this is important. As I said, it's important for them to have control. They have the marketplace. They are at the core of the market. They don't manipulate the market, in my opinion, but they just make sure that all gold is going through their market, through the Shanghai Gold Exchange. And I'll just have to get rid of these. And I'm fortunate enough, I'm running 3 different bullion dealers. I run one in Sweden. I started in Sweden in 2008. I have a company in Sweden called Liberty Silver. I have one bullion dealer in Estonia, and now, of course, BullionStar here in Singapore. So I'm fortunate enough to be able to compare the Western and the Eastern mentality. And the Western and Eastern mentality are quite different, actually, indeed. Because you can see that Westerners, they are buying gold as investors. They are trend followers. So they want to buy following the trend as an investment to get a return on their investment. But the Eastern philosophy is quite different. Here we can see that we get lines here, as you might have experienced when the price drops. Whereas, in Sweden is quite small market, but the same in Europe and the US. People are selling when the price is dropping, so they sell at the bottom and they buy at the top. Whereas you guys gain because then this gold they are selling is shipped over here pretty much, and you can buy it to bargain price. So it's all good. So this is the difference between the Western and Eastern mentality. People around this region of the world understand that gold is savings. It's not investment. You buy when you have discretionary income, and you buy it as savings. The price is not so important in terms of US dollar or Singapore dollar, because after all, US dollar, Singapore dollar, any currency is not a good measurement for the price of gold. It should be the other way around. And we're trying to educate people in this because we have a BullionStar charts, as you might have seen, where you can actually measure other assets, different assets, like a stock exchange index, for example, or a stock or a base metal, in terms of gold. Because gold is a much better measuring stick, a much better ruler than any fiat currency. Gold has kept its value or increased its value over time. Fiat currency hasn't. So why do we use fiat currency to measure anything? What if you have 100 centimeters 100 years ago, which is 1 centimeter today? That's not very helpful, but that's what's happened to our current monetary system. So whereas gold is much more stable, so we should use gold as the core denominator for measuring things. So Eastern mentality again, buy when it's cheap and hold for long-term storage. Now, what should we do? What strategy should we adopt? What can we learn from all of this? What are the giants, meaning the super producers, the super wealthy, the old European aristocrats, Middle East oil barons, what are they all doing? Well, they are buying tangible assets, and they are buying, first of all, they're buying precious metals. And when they have, more than enough, perhaps they buy some other tangible assets. It might be that they're buying some land. They might be buying some old castles in Europe, just because they can. It's a tangible asset. But even if you're a small-time saver, you can follow their wisdom. You can tag along. You can buy, a couple of silver coins or this 1 gram gold, not this one, but 1 gram gold bar. So tag along their wisdom is the strategy I'm advising. And that's a very easy strategy. So what we can remember is that the price of gold, even if it goes down, this is a good sign because it it comes very close. We're very close right now to the price of physical gold decoupling from the fiat price, because there is shortages. I'm struggling to replenish our stock supply because there is nothing available. For silver coins, you know, silver maple, silver philharmonic, silver eagles, there's 2 months delivery time from anyone right now, and the premiums are sky high. There's nothing available. Gold coins, it's a couple of weeks, but it's getting worse and worse. So we're trying to be, you know, we're trying to be aggressive in replenishing, but it's getting more and more difficult. And there are widespread shortages. So the lower the price of gold goes, the paper price of gold, closer we get to the inflection point of revaluation. And that's going to be when there is no physical gold and silver available to today's gold and silver paper prices. And then it will have to revalue. And I mean, it's not going to be a 10% revaluation, because if the market has to balance in terms of physical supply and demand, we're talking, I mean, 5-fold, 10-fold, who knows? But it's going to be a major revaluation. And so that concludes my presentation. And following me, our COO, Mr. Luc Chua, will talk a bit more about the gold price and silver prices, and also a bit about the developments, what we're doing here for you to be able to, you know, save in precious metals. Thank you.